Today, we're breaking down the truth about ETFs. You've probably heard a lot about them, and for a good reason. They're low cost, they're generally passive, and they're pretty tax efficient. But as most things in finance, the truth is a bit more nuanced. We're going to unpack what ETFs really are and the three biggest misconceptions around them. My name's Foster Martins, and I'm a certified financial planner based here in Canada. All right, let's start from the top. First of all, what exactly is an ETF? It stands for Exchange Traded Fund. Think of it as a basket of investments, whether it be stocks, bonds, or even commodities, that trades on an exchange just like a stock. ETFs come in all shapes and sizes. Some track a broad market index like the S&P 500, others might track specific sectors like clean energy or tech, and then there are some very niche ones that try to track, say, cybersecurity companies or even space exploration stocks. At their core, ETFs are just a legal structure for holding investments, but that structure changes how they're traded, taxed, and managed compared to something like a mutual fund. Now we'll get into the three biggest misconceptions around ETFs. So the first common misconception is that all ETFs are passive, but that's not actually true. In 2025, active ETFs saw record inflows, about $44.8 billion in a single month. It's a lot of money moving into ETFs that aren't simply tracking an index fund. Active ETFs are managed by a portfolio manager who's picking and choosing investments, trying to outperform the market, trying to time the market, just like an active mutual fund. And here's the kicker. The fees on active ETFs can actually be the same or higher than some active mutual funds. So while ETFs are often cheaper, they're not automatically the cheapest option on the shelf. This brings us to the second major misconception. ETFs are inherently better than mutual funds. Now, the answer is not necessarily. I regularly see people online blankly saying just avoid mutual funds at all costs and only buy ETFs. But the truth is, they can hold very similar investments, sometimes even identical ones. The main difference is just how they're structured and how they handle transactions within the funds themselves. With an ETF, when you buy or sell, you're doing so on the exchange. Those trades don't trigger any internal capital gains within the fund, so it's generally more tax efficient. Mutual funds, on the other hand, have to sell investments when investors redeem their units. That can create an internal capital gain, meaning even if you didn't personally sell anything during the year, you could still end up with a tax bill because they had to sell investments inside the fund to give money to investors when they want to take money out. Active mutual funds are hit especially hard by this because they're constantly buying and selling inside the fund, and that they ultimately have to decide whether they pay tax or pass it on to you. Generally, they pass it on to the investors. But there's one area where mutual funds can still have a bit of an edge: dollar cost averaging. If you're making small regular contributions, mutual funds often allow you to make small contributions without worrying about the share price or transaction costs. ETFs trade like stocks, so you have to buy whole units unless your platform allows fractional shares. It's a small thing, but can sometimes make a difference for some investors who are just getting started. Interestingly, we're also starting to see mutual fund wrappers that actually just hold single ETFs inside of them, kind of combining the mechanics of both. Generally, we're seeing the lines between mutual funds and ETFs blurring together and sharing some similar characteristics. The final misconception is that all index ETFs are good. When John Bogle, the father of index investing, wrote the Little Book of Common Sense Investing, this idea was simple yet profound and controversial at the time. Track a broad, diversified index of well-known companies at a low cost. But the word index has been stretched a lot since then. Over the past few years, we've seen record inflows into index products, and naturally, fund providers have jumped in to try to get a piece of the action. Because of this, we now have thousands of ETFs that track everything from AI-powered dividend growth or pet care innovation. Some of these are very specific, and that means that they're often under-diversified and carry more risk. Then there are leveraged ETFs, which are designed to amplify daily returns. These aren't really meant for long-term investors. They're generally short-term trading tools, so holding them over a long time period can actually lead to losses even if the underlying index has gone up. I've seen some ETFs so niche that they can become illiquid, meaning if the market moves quickly, you may not be able to sell without taking a huge hit on price or paying fees. So while indexing sounds safe, it really depends on what you're indexing or what you're trying to track. Again, the idea originally was a broad, simple, low-cost investment solution. What we're seeing now is a flood of complex products wearing the same index fund label, but it can be pretty misleading. So here's the bottom line. Be careful with absolutes, especially in investing. ETFs can be fantastic tools. They can be tax efficient, cost effective, and pretty easy to trade, but they're not automatically better than mutual funds by default, and not all ETFs are created equal. Whenever you hear ETFs are always better or just buy an index, take a step back and ask yourself which ETF, what's inside of it, and how's it managed. Because if there was truly one single best investment structure, every dollar in the market would likely already be there. Like most things in personal finance, what you invest in depends on your goals, your timeline, and how you use them. Thanks for watching, and I hope you found this useful.